This 400-year-old system controls whether you have a job tomorrow, and most people have no idea how it works. The stock market isn't just numbers on a screen. It's the engine that drives modern capitalism, and its history is more fascinating than you might think. In 1602, the Dutch East India Company created the world's first official stock exchange in Amsterdam, issuing the first publicly traded shares. This revolutionary concept allowed ordinary investors to own a piece of a business. Fast forward to 1792, when 24 brokers signed the Buttonwood Agreement in New York, establishing what would become the New York Stock Exchange. From these humble beginnings, we now have a global network of exchanges: the Nasdaq London Stock Exchange, Tokyo Stock Exchange, all facilitating trillions of dollars in daily transactions. Here's what most people don't understand. When you buy a stock, you're not just making a bet. You're becoming a partial owner of that company. The stock market is essentially a massive marketplace where investors buy and sell these ownership stakes, called shares. A stock market is a marketplace where investors buy and sell ownership in companies known as shares or stocks. When you buy a stock, you own a small part of that company. The value of your stock can go up or down based on the company's performance, market demand, and economic conditions. Companies list their shares on exchanges to raise capital for growth, and investors provide that capital in exchange for potential profits. Stock prices fluctuate in real time based on supply and demand, company performance, and broader economic conditions. Why do people participate in this system? There are several reasons. First, profit. If the stock value increases, investors can sell it for a gain. Second, dividends. Some companies pay profits to shareholders regularly. Third, ownership. Buying stocks makes you a partial owner of the company. Fourth, portfolio growth. It's a way to build wealth over time. The advantages are compelling. Historically, stocks have outperformed other investments. They're highly liquid. They offer diversification opportunities, and they can beat inflation over time. But here's the reality check. The stock market is not a guaranteed money machine. Market volatility can wipe out fortunes overnight. Poor investment decisions or economic downturns can devastate your wealth. Emotional investing, driven by fear and greed, leads to costly mistakes. Success requires knowledge, research, strategy, and timing. But there are also disadvantages and risks: market volatility, risk of loss, emotional investing, and the need for knowledge and research. Yet despite these risks, the stock market remains the backbone of economic growth. It enables capital formation, allowing businesses to expand and hire. It generates government revenue through taxes on capital gains and corporate profits. It democratizes wealth building for the middle class. A thriving stock market signals economic health and attracts foreign investment. Countries like the United States, India, and Japan have experienced massive economic booms precisely because of their vibrant stock markets and investor confidence. Tips for beginners. Don't invest blindly. Always research before buying any stock. Start small and understand your risk tolerance. Only invest what you can afford to lose. Avoid following hype and rumors. Make decisions based on facts, not emotions. Diversify your investments to reduce risk. Don't put all your money in one stock. Learn about mutual funds, ETFs, and index funds. These can help you start investing with less risk.